two different types of returns are often cited when talking about investment returns. There's just price return, which is pretty self-explanatory. It's just the price action. So a stock between August 1st and August 31st went from 25 to 30. That's a 20% price return. But the other type of return is total return, which incorporates dividends paid during that time frame. So same example above, the stock went from 25 to 30, but it paid a 50% or a 50-cent dividend. The total return for that investment is 22% as opposed to 20. DataTrek Research, who does great market research, they have great market insights, shared recently the 5-year price and total returns for the S&P 500 compared to other investing benchmarks. So how did it stack up? Over the last 5 years, which brings us back to August of 2020, just after, this was during the COVID stock market recovery. So August 2020 to August 2025, on a price return, the NASDAQ index has outperformed the S&P 500 index, 93% for the NASDAQ and 89.4% for the S&P 500. But on a total return basis, the S&P 500 outperformed the NASDAQ 103.9% for the S&P versus 100.2% for the NASDAQ. You can see it's about a 10% increase or a 10 percentage point increase for each of the investments. So the total return is more than the price return. S&P 500 companies tend to pay, more dividends than the growth-oriented stocks of the NASDAQ. So, that's just a feather in the cap of dividend reinvestment. Overall difference is 3.7% S&P versus the NASDAQ over 5 years. Less than 1% per year, you might say, but extrapolate that out over an entire investing lifetime, and it could really make a difference. It said when we're talking about investing fees and taxes, that it's what you get to keep that matters. It's what's left at the end that matters, which is so true. And the same can be said for total return versus price return. It's the entirety of the returns that matters, not just what the price is doing. A couple other quick points. Should you stop reinvesting dividends when the market goes down? Depends on your time horizon. If you've got years left to go, I say no, you shouldn't. You'll be buying more shares of your investments with those reinvested dividends. If the price goes down, you'll be buying more shares along the way, which should help your performance over the long run. We did a recent video on that, so go over to that and check it out if you want to learn more about investing more as the market goes down or continuing to invest as the market goes down. When should you not reinvest dividends? You can make the case that if you're relying on your investments for income, that you should just receive the dividends in cash and pay them out of your account. But you'll need to coordinate that on a monthly basis. If you want to just hold the cash in your account instead of paying it out, could tamp down the volatility, during turbulent times in the market, which definitely has its benefits there. But if you have dividend reinvestment on as part of a diversified portfolio that matches your risk tolerance, and you have money for expenses and short-term instruments that aren't being spun around in the market, then you can probably leave dividend reinvestment on and it'll help your long-term returns. But, each case is different with that. Like a lot of things, dividend reinvestment is a small tweak. It's literally, oftentimes it's just a button on your account homepage that you can click or not click if you want to put dividend reinvestment on. So it's a small tweak that you can make to your investments that can pay large dividends over time. See what I did there? You're literally getting dividends. Thanks for watching.